Welcome, everyone. It's very fantastic to see such a great turnout today. Since we launched Termgrid in 2020, our community has rapidly expanded to include over 900 institutions now and more than 15,000 leverage finance professionals, all working on transactions across the globe through our platform. So very excited to have all of you here. The inspiration behind launching Termgrid Talks series was a recognition of a significant gap in the market that we see for practical, insightful content tailored specifically for the leverage finance community. We wanted to create a platform where industry leaders such as Chris could share their perspectives on key trends and emerging themes, providing real value to professionals such as yourself. Today, we are thrilled to kick this series off with an exceptional guest, Chris Skinner. Chris is the global head of debt and capital advisory at Deloitte, and he's been a trailblazer in the space since co-founding the business in 2005 now, so 2 decades ago almost. And over the past 2 decades, he's grown the team from 4 to over hundreds of people, across the globe. So please join me in welcoming Chris Skinner. Before I turn it over to him, a quick word about the data that is referenced in the presentation here. At the platform level, we have access to a lot of aggregated and anonymized data across the financing launches worldwide. And while the transactions themselves are confidential, inaccessible to us, we do gather some valuable insights along the dimensions of, such as where are the deals getting launched? Are they getting launched in US, Europe, Asia? What are the types of deals that people are working on? Are they new deals, refis, add-ons? And the aggregate number of lenders that people are working on a financing with. As you can imagine, this information serves as a leading indicator for the real-time deal activity in the financing markets, providing a little bit more current view of the market dynamics compared to retrospective announcements of closed and completed transactions. So with that, Chris, welcome. Over to you.
Well, thank you so much, Dipesh. And what an absolute privilege it is to be part of this Termgrid Talks series. So team, what I was going to try and do today in conversation with Dipesh and the rest of the team was try and test out a central hypothesis, having had a sneak preview of some of the Termgrid data that they provided. The thesis, if you like, that we're going to try and test out today is if the world that we're living in today is just the same old, or a brave new world. But first things first, let's just set some context. So first thing, what I want to try and do is just present some time series data. The blue wiggly line, that is the US Federal Reserve interest rates. The orange bar charts, those are default rates. Now, what I really want to try and highlight is that, as people can hopefully see, every time default rates have spiked, the default response from not just the US government, but the ECB, the Bank of England, in fact, public banks around the world have responded by cutting interest rates. That was true during the Nikkei crash, .com, during the global financial crisis, and during COVID as well. The thing is that after COVID, suddenly when there was a huge amount of quantitative easing, interest rates had in effect plummeted to just about as low as they could go. Since then, everything has changed. Base rates have spiked back up, margins have spiked. In turn, that's directly fed through to additional interest costs that portfolio companies need to borrow, around 2 times more per $100 million worth of money borrowed. And that in turn has reduced down the debt capacity that portfolio companies can borrow against 5.5 times based on some very rough maths. And we think that this plays out empirically down by about 1.5 turns worth of leverage, which of course then cascades all the way through to the system, through the leverage system, through to EV, and of course, ultimately returns. But if that's the context, what does that mean for us right now? Well, let's have a look at some of the data that Dipesh and the team have provided. Let's look at the first half of 2024. And what we can immediately see is that there are some differences start to emerge between Europe and the US. Here's growth by month. And what I want people to concentrate on is just this divergence that we saw a little bit earlier on in the summer, which is built on when you aggregate that up and you look at the whole of the first half of 24, you see exactly the same effect. So in other words, it's not just 1 month, actually you're starting to see it flow through. What you also see is that when you look through the types of deal, that yes, although activity levels have started to diverge, the types of deals that people are doing is very similar, or put more accurately, the absence of one particular type of deals, which is tapping the existing lender base through an add-on, whether that's for M&A or other types of add-ons, has plummeted. And that is consistent across the US and indeed Europe. And that has in turn been driven especially by the return of the large cap market. And you can see here, as much as anything, if you look here at the yellow, that is the low and mid market. You can see the decline there, but really it's the bounce back of the large cap markets that for us really stands out. So if we're just trying to recap this last 5 minutes or so, what are we really saying? Well, we're saying three things. First of all, that there are some divergent trends that we're seeing between Europe and the US. We're seeing that new deals are now definitely getting done, but they're not getting done through add-ons. And lastly, we're seeing the return of large cap deals. Okay, so if that's where we are.
One question
Yeah,
for
please.
you, Chris.
Yeah.
As we are recapping the first half of the year, in one of the previous slides, we also saw the lower middle market and the impact that it's had over the past first half of the year, where it's lagging the large cap and the middle market. So from your vantage point and serving clients across various segments, what do you see in the lower middle market happening that is driving that, perhaps?
Well, look, I think it's a great question. I think it's a function of two things. Firstly, I think it's actually just a normalization effect. Actually, last year, looking back, there were plenty of deals getting done in the lower mid market. There were very few deals done in the large cap space. So actually, a big part of it is just reversion to mean, if you see what I mean. But I think the second part to it, which I think we can see persist, is that the fundraising environment for new funds, particularly in the lower mid market, is actually really pretty tough. If you're a super jumbo fund, you've got a bunch of LPs that are fully committed to you as a direct lender or as a credit fund. Actually, the reality is going back to those folks, even though it's tough, of course, because nothing's ever easy, even though going back to those folks isn't that straightforward, it's so much easier than starting a debut fund typically in the low mid market. So I think there's two separate effects going on there, Dipesh.
Awesome.
Yeah, if I just jump straight in. So with that recap and with Dipesh's question, if I just go, okay, so if that's the macro picture, what is happening right now? And more specifically for folks on the line, I know that the question that I would always want to know is, what are my peers in the market doing differently? Has anything changed? And actually, I think some of this data I think is really interesting. What I want to draw people's attention to here is July. And you see just how pronounced that July spike was, well over 100% up on the equivalent period last year. So people have been working over the summer, but actually they've been doing that in a format that they haven't historically done, i.e. they've been getting deals done faster. How do we see that? Well, through the Termgrid data, you can see the number of lenders that people have approached, which is actually lower than it's been before. So in other words, people are going to a tighter group of people and doing so with fewer turns of a term sheet. Smaller, more concentrated groups getting deals done, working harder, arguably, than they've ever worked over the summer. So we can add that to our interim conclusion, if you like, in addition to the three previous points that we just touched on. People have trashed their summers, and actually they're in a rush to get stuff done.
Awesome.
Dipesh, is this what you're also seeing as well, just anecdotally and from feedback from the community?
Absolutely, and I think across the clients that we work with, I think to extend the July data even further, the growth rates persisted during August as well. Europe was 0% year over year, so I think the Europeans, the deal activity is kind of similar. They work the same way every year.
Yeah.
But in US at least, the deal volume was up 54%. Of new launches in August this year versus same time last year, the same cohort of customers. So that was very interesting. So I think there is definitely a leading indicator of the activity is back and people are more busy. We've also heard a lot from clients that people are canceling their vacations and kind of, just maybe the greed is back or something along the line. So I think people are definitely busy. Maybe one question here on your final point here, when you say that like people are in a rush to get stuff done, which we also see. what types of deals do you think, Chris, from a borrower's perspective, they're able to negotiate today and get done at this time versus what they were able to do over the past, couple of years? Any major differences, movements, changes, deltas that you want to call out, highlight?
Yeah, so I think we're still some way away from large scale, major systemic divvy recaps. That still feels like quite a long way away. But what we are starting to see is the first step in that journey, which is in effect repricings. Now, just because of the nature of the market, and you know this as well, loads of the community on the line will know this, that you see repricings more through the large cap market simply because it's easier to do if you've got a group, for example, of CLOs holding your paper than it is in the mid-market or the low mid-market. But you can start to see that kind of activity. What's interesting is if I look at our pipeline, so we've got a better pipeline now than we've ever had. Last year, just for context, out of the UK, we did 86 financings of various different guises. Our pipeline, and I know this because I had to look it up first thing this morning for something for an internal session. Our pipeline right now, we've got 24 live deals on. And when you look at the division of that, it is almost exclusively M&A related. So I think what we're seeing is that the people that are doing deals now are the people that can see via M&A how they can grow the value of their portfolio company, and then a relatively smaller amount of deals where it's either a repricing or it's a full refinancing. But our thesis, which is part of this subject, which is why it's such a great question, such a leading question, is actually those are the sorts of deals that we're going to start to see come back more and more as liquidity comes back into the market.
Right. That's good news for everyone.
Well, and maybe if I just use that as a little segue and just touch on, if you like, the big question, which is why. So why are we seeing these dynamics that we've just touched on? Well, this is where I want to try and close off on the arc, if you like, and come all the way back to where we started. Let's just have one last look at those interest rates that we talked about. So what I want people to try and just imagine, if I just lift up that entire chart, and hopefully you'll see exactly what I'm talking about here. I draw a line all the way underneath that interest rate line where it effectively hit zero and simply couldn't get any lower. Of course, what was really happening was there was huge amounts worth of quantitative easing coming into the system. So in effect, effective interest rates, if you like, were actually negative. And Dipesh, because I know that you're a data-driven person just like I am, I actually looked it up this morning as well. The size of the existing Fed, ECB, and UK balance sheets, had I been smart enough, would have put this out to the community to try and get people to vote on it. But just to ruin the punchline, US Fed Reserve balance sheet, $8 trillion, ECB, 7.7 trillion euros, even the UK alone, 0.9 trillion pounds. So the thick end of £1 trillion worth, even just for the UK, let alone ECB and the US. So if I use that as a thread to come back to where we started, and this is to wrap us up, and then of course, if people have any questions, we'd love to take them between us. I know, Dipesh, I know you're keen to try and dive into any questions that people might have. So I think we've now got all the data to try and prove out, or at least throw out that hypothesis. Is this the same old, or a brave new world? Well, what I'd say is, look, it's become pretty clear that Europe and the US are on different paths, that large cap is back. People are rushing to do new deals, but not wanting to tap their existing financing. And there's one thread that I think underpins each of those. There is one underlying fundamental, if you like, which is that effective interest rates make the world go round. But if we're thinking here about practitioners and about deal doers, you would say, okay, amazing. We've lived through this incredible boom, in effect, this injection of vast amounts worth of free money and tremendous amounts of liquidity. But we've also seen some examples where it's pretty obvious that sovereign borrowing has reached a limit and where we can't simply carry that on. So back to the same old question, Is it the same old, same old? Well, definitively, it feels to us like the world has changed. But I would say that it's changed relative to last year and actually relative to where we were 5 or 6 years ago. We're back to that. So, like with all good hypotheses, it's a bit of one and a bit of the other. But Dipesh, before we came on, you challenged me to try and come up with one snappy, sizzly way to try and close the session that people might remember. Look, if we really believe this hypothesis that actually we've had this tremendous influx worth of government-sponsored money, that yes, we've had a bit of a glitch in the matrix over the last couple of years, but now that's back. Well, what I'd say is these things don't always persist. So my recommendation is to get it while it's hot.
That's the tagline.
So with that, Dipesh, back to you.
So everyone, if you have any questions for Chris, please feel free to use the Q&A function to submit those. We got a few questions on email as well, so we're going to start running through those, but please get your questions in. So maybe you kick off the Q&A, Chris. One of the questions that we got from the community was, from your vantage point and the seat that you said, what will you advise the borrowers today on the best and most efficient way to get deals done in this market? Because they're all trying to get it while it's hot. So what are the common themes to succeed to get a deal done today?
Okay, well, look, I'm just going to desperately try and resist the temptation to go with hire the world's largest debt advisor, powered by the world's leading preeminent a Termgrid provider. But no, I think the reality is that we are going through a structural change in the market. Our mission objective, if I think about the original vision that we had when we set our team up, it was that money, and here in this example, credit, is the ultimate perfect market. If you go back to your Adam Smith economics, many buyers, many sellers, low transaction fees, homogeneous product. The reality is that what should be able to happen is that we should be able to take money from anywhere in the globe and then allocate it to somewhere else. And our mission, and the reason why we set the team up, was to be able to do exactly that, to enable borrowers to expand their own platforms, grow their businesses, create more jobs, make the world a better place. I don't think that anything has changed in that. So back to your question, what do I think that people could do? It's very, very tempting in a market like this to go back to the same 3, 4, 5, 6 people that they've always gone to. And there's no reason why you wouldn't. But I think the difference between a really good deal today and an outstanding deal is massive. And the way that you do that is you bring in competition. And ideally, you do that best by bringing in competition from around the globe.
Perfect. Awesome. We have some questions coming in here. That's good. Maybe we go to the next one here. Now this is from a lender's perspective, right? So from 80% of the audience today is from the lending community.
Sure.
The direct lending markets have become very deep and complex over the years, ever more than before, right? So what do you think in this ever competing, ever complex market would make direct lenders differentiate more in a market, which is increasingly getting dominated by players that have bigger and bigger funds, and what's the right to win? Yeah,
look, I think it's a great question. So for me, what you really want to do is the framework that I would suggest is you want to look at the people that purchase your product and see what they're doing. Now, if I take that as an example, if I look at private equity, for example, whereas let's say 5, 6 years ago, it would be pretty rare to have a truly dedicated sector specialism. People might have said that they did, but the reality of actually doing it was somewhere away. That has now definitively changed. And actually, my personal view is that virtually everyone has some form of sector alignment. And there are plenty of funds now that only operate in one sector, like, for example, software or SaaS. But I haven't seen that same evolution to anything like the same degree on the credit side. It doesn't mean that there aren't some examples of it, but there hasn't been the same kind of wholesale change. So, Dipesh, I know that we were comparing notes on this a couple of weeks ago. But one of the great strategic changes that we as a business are going through, and which we just started doing over the summer, is to do exactly that with our own business. So we're going to take 113 people and in effect tilt them. It doesn't mean that we're going to lose the focus and the relationships that they already have, but we're going to tilt them much more towards industry and sector alignments, because that's the way that we think that our own customers invest their money and therefore buy our product. And our product as professional service providers is no different to the product, i.e. credit, provided by the people that you were addressing initially.
Interesting. I mean, moving towards like a sector coverage model, I mean, that's a very interesting, from an advisory perspective as well, because I think there are certain direct lenders that are sector covered, like to their coverage. Right. So maybe that trend is underpinning some of the growth in the industry as well, but very interesting viewpoints on figuring out how do you stand out with that sort of a model a little bit more. There are a couple more questions here. I think the one is about yield compression. Where we have also done a survey recently where we poll our community for their sentiment towards the next 6 months, and one of the themes that came out, Chris, was about yield compression. That the yields have compressed because of surplus liquidity, predominantly floating around in the markets, which is tied to the point about the quantitative easing, and there's just so much cash floating around. Now, one of the questions that is on everybody's mind is, and this has also come through, is what's the outlook on pricing now? For the next, how will it evolve over the next 12 to 24 months? Have we hit a floor? Is there more room for it to go further down, for compress more, compete more? Any viewpoint, any house view that you guys have on that?
Yeah. So yes. With a slightly provocative asterisk. So on the yes, I think it's pretty obvious. If I go all the way back to when we first set up 2005, 2006, it's dead straightforward, right? Base rates were 6%. You then had 2 points, 3 points, depending on whether you had an ABC structure. You'll remember this back to the old days. And your all-in cost of financing was something like 8 or 9 points. You then fast forward right up until a few years ago, and you get, okay, right, so base rates, call it 1, and then you end up charging, let's say, 650 unitranche. You get back to somewhere in the same sort of zone. What you can't do, because the market will just slow down and in effect stop, which is what we saw last year, is have base rates and the risk-free rates explode up to 5, 6, 7%, and then charge 650 or 700 on top. Deals just can't get done. Doesn't mean that you can't deploy that money. Mostly, though, you're doing that through the secondary market and you're picking up through BWICs, etc. But doing it through primary deals is much, much harder. And so that's exactly what happened in the market simply stalled. I feel like now we're going through two different dynamics or two different phases. The first one is just that we've hit a bit of a plateau. Things have just calmed down a bit. They're not necessarily going up. They're not necessarily going down. And just stability is enough to be able to price a deal and get some money out the door. But yeah, can I look forward and see yield compression coming in? 100%, especially as some of the bigger funds that are being raised or have been raised really start deploying in anger all of the, I'm going to say cheap, but all of, if you like, the undervalued stuff, stuff below par in the secondary market gets hoovered up. Suddenly, actually, the only place that you're left to try and deploy is back into the primary market. So yes, but the asterisk is maybe not for a little while. And when I say a little while, what I really mean is Friday.
Awesome. One more question here, and I think this kind of ties to the point that you made that a lot of the mandates that you guys have at the moment, they're largely M&A focused, right? Yeah. So it's new deals, which is good news for the entire industry. Do you think the amend and extend activity and the repricings is in the rear view mirror, or do you think there's still a backlog of that activity still remaining to be flushed through the system?
Right. So let me just let me try and do my best to not meander my way through to an answer. But I'm just going to try and nuance and amend and extend versus a repricing. So where I'm headed with this is, if I imagine I've got a deal, it was a slightly uncomfortable deal, it was probably priced a bit too high, but I was faced with an upcoming maturity. I'd probably extended it a couple of times already, and now suddenly I ended up having to bite the bullet, maybe even put some more equity in and just get a deal done. And when I say that kind of period that I'm thinking of is the last 2.5 years. If I've now got that deal and there's a EV accretive M&A deal in the wings, I've in effect got three different options. I can either just suck it up and just go back, just tap that deal and just accept that I need to pay a load more, or I can break it into two phases. I can either do a mini repricing now, try and do something to make that deal a little bit better, and then tap it the blink of an eye later, or I can do a full refinancing now and then try and take advantage of it. But all of those three are very different to the sort of situations where you have distress and persistent distress. And those deals, if the last 20 years has taught us anything, it's that nobody ever bites the bullet. Everyone always wants to try and kick the can down the road. And those kind of amend and extends will carry on for a good amount of time, whether they should or they shouldn't.
Yeah. Awesome. I think that's the time that we have for today. Chris, again, from the Termgrid team, thank you very much for sharing your perspective with the community. Awesome to have you. And I hope everybody who tuned in today enjoyed the session of Termgrid Talks.
Wonderful. Thank you so much, team. Cheers all. Bye bye.
Thank you, everyone. Cheers.